All right, we have gone over context and we have gone over time. So now it is time to go over order flow entries. This is the first type of entries that we are going to go over. We're also going to over candle signs entries later on. Depends on your personal preference which one you like more. Now we have already gone over order flows. This is order flow part 2 because we have gone over order flow in the analyst month as well. Essentially what we're doing right now is the same that we did in that order flow video, but now there's something else linked to it because now we're actually looking to buy or place a sell order. Where the first thing, if we want to look at order flow entries, we need to understand the context time frame. And the context time frame is again that context area that we talked about at the end of the analyst month. That creates the context area creates where we want to look for our entries. So we know exactly where we potentially want to look for our entries. Then once that boundary PD array has been hit, we have that boundary hit to now go into a certain time frame to look for our order flow entries potentially. If that boundary is a monthly PD array that you are looking at, you would want to go into the 4-hour time frame to look for an order flow entry. If it's a weekly PD array right there, you would want to go into the 1 hour for your order flow entry. So every single one of these time frames that's in brackets, that's the entry time frame, where the top one is the context time frame. So if it's a daily context, we're going to the 15 minute. It's important here to understand that all these time frames are a minimum. So the further time frames are apart from one another. If you have a context time frame of the monthly and you are looking to use an entry time frame of the 5 minute while going into a monthly context time frame, that is so far apart that you're going to need more and more and more confirmation. It's extremely low probability as well. Where if we are looking at the 15 minute right there and we want to potentially confirm it with a 5 minute order flow entry, that's extremely high probability because those time frames are not very far apart. So confirming a weekly PD array, for example, with the daily order flow entry, that's also perfectly fine. Now, the reason I'm telling you this is because the time frames you are seeing here is the bare minimum. As in, the higher probability happens with more confirmation. Meaning, if you want to confirm a daily PD array with a 1 hour, that's higher probability than the 15 minute. So again, don't stick, again, you can stick to these time frames, yes, for sure. But don't have a mindset where Arjoio says you need to use these time frames, so you always need to stick to these exact time frames. No, the higher the time frame for the entry time frame, the closer it is to the context time frame, the better actually. So that's quite important to understand as long as you understand that everything here noted is the minimum. So don't go below that. Don't confirm a daily PD array with a 5 minute time frame. Don't do that, please. Now, with that being said, we can move on towards what is actually the order flow entry and what is actually the confirmation. The first thing we see is an ST right there, and an ST stands for a sharp turn. We have ugly sharp turns and we have good sharp turns. We're going to go over both. Then we have as well, like we see right here, we have the re in the second spot right there. The re is the order flow confirmation. So essentially what we're doing right here on the lower time frame is we are confirming the order flow like we also did in the analyst month with that order flow part 1 video. Then the order flow confirmation right there is exactly what our entry can potentially be. Then we have the time frame context right there. I'll explain what that means later on as well. Then where do we actually want to look to enter? Well, there are different possibilities and I'll go over every single one as well. But we can enter on an FVG creation where we can enter on the flood, the first line of defense, and we can enter on the overlapping defense as well. Whatever our personal preference is, but there's also a mechanical manner in which we can say, all right, we want to enter on the flood this time, or we want to only enter on the fair value gap creation. Let's start off with understanding good sharp turns. In my opinion, it is more important to differentiate or to see the bad sharp turns, because then it automatically also becomes very easy to see the good sharp turns. Now, for some examples on the sharp turn, we might not actually have a discount array or higher time frame context to the left right there. That is purely because I want to show you good STs and bad STs. Afterwards, when we go over actual entries, yes, we will of course have that context incorporated as well. This is just to drive my point home. Now, a good sharp turn leads to the understanding actually of what is high probability price action. High probability price action actually happens quite fast. So when we have a discount rate, higher time from context, or any context where we are expecting higher prices off of, then what we want to see is ideally some type of consolidation right there to create some liquidity as well in the market, to then have a sharp turn. A sharp turn creates the fair value gap in, momentum into the discount rate where we are actually expecting higher prices from. That momentum is good. Why is that good? Because it tricks people into the market right there. Why do we trick people in the market? Well, again, that leads back to the understanding of that liquidity. If we trick people into the market right there, not only can we buy at that moment in time, but also the stop loss that is above the highs right there, that is what we can look to target. So that creates right there the context area where we have that discount rate towards that first premium rate. That is again that context area that we have gone over. Then ideally we want to consolidate before that. Is it a must? No, but it is higher probability. Then the next thing that is the highest probability thing for it to do, or well, if that happens is the highest probability, then a sharp turn going into fair value gap, going into it right there, then creating a new fair value gap, going out of it right there. That is the highest probability for price to actually do. If it does that, perfect. That is absolutely perfect. Then this is ideally a fair value gap right there as well out to then continue higher off of that and continue higher towards the context high. Now, one thing that's important right here is to understand that the right side where we are actually looking for entries, it's going to be a faster side. So essentially what I've drawn right here is a simplified market maker buy model. You don't need to know the first leg of accumulation, the second leg of accumulation, it's all irrelevant. But you need to know that the right side of a market maker buy model, so the buy side, actually the buy side curve, is going to be the faster side if it is high probability. If that's not the case, then, and we have a slow price action, that's not what we want to see. So that also relates to understanding how a sharp turn should form and after we should form. It should be extremely fast price action. Now, let's look at the example that we had right here on crude oil as well. What do we see? We see this consolidation right there just before we sting into a discount rate right there, and then we create a sharp turn. A sharp turn is again a fair value gap going into the discount rate, ideally in the most recent leg that we have right there going into the discount rate. After we come out of that discount rate, we have new fair value gaps coming, pushing higher again. Fair value gap in, fair value gap out right there. That creates a sharp turn. A sharp turn oftentimes, and a thing I oftentimes see as well, is a comment, oh, it's just a BPR. A sharp turn is not a BPR. And if you're familiar with a BPR, I'll quickly explain it. A BPR is an overlapping fair value gap. So where we have two fair value gaps overlapping right there, that creates a balanced price range. That is not necessarily a sharp turn. Because yes, every BPR is a sharp turn. But not every sharp turn is a BPR, because those fair value gaps don't have to be overlapping all the time. Some might be higher, so the fair value gap in might be lower or might be higher than the fair value gap going out. That is not relevant. As long as we have those two sharp turns, or those two fair value gaps right there, going in and going out, that creates the sharp turn. Now, if we take a look at this example as well, right here, we had a discount rate actually towards the left right there, which was a 4-hour fair value gap. And once we came into that, we have momentum going into that. Perfect, exactly what you want to see. Then we have fair value gaps going out of it right here as well. That is also exactly what we want to see. These sharp turns that I just showed you, these are extremely high probability sharp turns right here. Perfect momentum, perfect intention right there to actually move higher. These are very high probability. But if we go over a few sharp turns that are not high probability, then this right here on Euro USD is one example where we do have a good sharp turn right there. Fair value gap going in that liquidity right there and going below the liquidity again. Fair value gap in, fair value gap out. But afterwards, what happens is we consolidate right there. Again, any type of price action that we have during our entry confirmation that consolidates, whether it be just the ST its own, which is already consolidation, if we consolidate after the ST retracing back into it, never a good sign. high probability conditions happen fast. We have trapped people. We need to move to the opposing side fast, fast, fast. If that does not happen, that is suspicious, and that's not what we would want to see. So here we have another example as well on Euro US dollar, where we come below this discount array right there. We have fair value gaps going into that. Perfect. Now it takes a while before we actually continue higher, and sometimes it might actually take a while before we create a new fair value gap going out. So right here, for example, the first fair value gap going out is actually sitting right there. Is that a sharp turn? Yes, definitely. It is a sharp turn. We have a fair value gap going in right there, and we have a fair value gap going out. Is that a sharp turn that you actually want to look to actively trade? Absolutely not. This is the ugliest ST that you can have. An ugly ST right there is a consolidation before we actually have the significant move. Now this right here, for example, once we take out this ugly ST, and then we have a new fair value gap in, new fair value gap out, can you see the difference in momentum and intention right there? Immediate, no playing around. Fair value gap in, fair value gap out, immediately following through after one another. That is extremely high probability. So that also tells you which sharp turns you actually want to look to trade off of. Here we are on GBP US dollar. This gray box right there is a daily fair value gap, where if we want to continue lower, we have this target sitting right there, the context low. Now, once we tap into that daily fair value gap right there, we actually, right here, what do we see? We see that we create a sharp turn actually early on right here at that moment in time. And this is actually, that's an all right sharp turn. It's not a perfect sharp turn, but it's not a bad sharp turn. It's not horrible right there. That is still a sharp turn. Now, after, what do we see? We start to fill, as in we just do not continue lower anymore. Once we take out that first sharp turn right there, even though time is not agreeing at that moment in time, every sharp turn that we create after is not something you would necessarily want to look to trade off of. Even though time is agreeing, if we already can come into that premium rate right there, or we can continue lower off of, we already created the sharp turn right here on the 15-minute time frame, we do not necessarily want to look at a new sharp turn after that. So these sharp turns right here is not something that we should be interested in, because they, again, are low probability because the previous sharp turns have not followed through. So these can also be called as one, a sharp turn right there. An ugly sharp turn right here in a big consolidation. Again, it already says in the name, right? It's a sharp turn. It's not a consolidation turn. It's not a big turn. It's a sharp turn. It's a fast turn. It needs to be extremely sharp. It happens fast. Now, the same can be said right here on Bitcoin, actually, where we can continue higher off of that gray box source left. Once we come into that, we create order flow going into that, actually. We create a fair value gap going in. Now, at this moment in time, we create these fair value gaps right there, and we have premium arrays that are still following through at that moment in time. When we have premium arrays still following through and we never have created a sharp turn before that, so inside the context area right there, we have not created a sharp turn actually going higher just yet. This is not necessarily a consolidating ST. This is not necessarily a bad ST, because there's still one side of the market actually following through. When we consolidate, the definition of a consolidation is both sides of the market are not following through. Where we have premium rates not following through and discount rates are also not following through. But here premium rates are still following through with new fair value gaps going lower. This actually is a really good visualization of the order flow transition. Why? Because when we come into this premium rate, that fair value gap right there, if we still want to continue lower, we should create a new fair value gap going lower, just following through on order flow going lower right there on the 15 minutes. But what do we see? We failed to create a 15-minute fair value gap going lower right there, and we actually create a bullish fair value gap. So even though at first sight this might be considered as a consolidating ST, it's actually not. It's a beautiful sharp turn because you have the order flow visualization right there as well. Premium rates start to fail to follow through. We create right there a new fair value going higher. That's actually a really good sharp turn. Still, again, I would argue that this is the second highest probability, where the first highest probability is again that fair value gap in, fair value gap out, the first example that we had. Then right here, this is still a sharp turn that I would also look to trade. It's still high probability in my opinion. But the consolidating sharp turns where both sides are not following through, that is low probability. Now, really quick, going back to the PowerPoint right here, we have gone over the sharp turn. Now we need to go over the re. So what exactly is that re? The order flow confirmation again. The time frame context, enter on FVG creation, enter on float, enter on odd. Let's go over that. So what exactly is the re? After the ST, we get a re, which is the order flow confirmation part. So again, let's remind ourselves, what is that order flow confirmation? Right here, when we look at this 1 hour gray box right there, that 1 hour fair value, which we can continue lower off of this fair value area. We can also continue lower off of right there. And the context is towards this low right there, that swing low that we have. So that creates, again, the context area. Because from that gray box towards this low right there, that's the context area. Now, in between that, if we want to go into the lower time frame, 1 hour is linked to the 1 minute for an order flow entry right there. Perfect. So right here, we get our sharp turn. We have a fair value gap into that 1 hour fair value gap right there. We have the fair value gap out right there. Is that already an entry? No. What we now would like to see is a new fair value gap lower off of a premium array that is inside that sharp turn. Whatever premium array it is, can be a swing high, can be a fair value gap, can be a breaker, can be a mitigation block, order block, whatever it may be. As long as we continue lower off of any premium array right there and we create a new fair value gap lower, then that is our entry. That is our re-entry. So the re-entry, to find the fair value gap, we have a fair value gap sitting right there. So that right there is the re. We have the ST, which is the first order flow leg right there, and the re is the second order flow leg continuing lower right there, which is confirmed by that fair value gap sitting right there. Now we have a couple of options, because when we create that re, we can now either enter on the fair value gap creation itself, we can enter on the fair value gap, or we can enter on the float, or we can enter on the odd, whatever it may be. Now, I like to have a few rules around that. And my few rules is the following. We need to understand, I target 1 to 2R. I cover my stop loss where we have no reason to return back to. So we're going to go over stop loss placement a little bit deeper as well later on. But I place it where price has no reason to return to. Inside that context area right there, if I can target a 1 to 2 RR, 1 to 2 risk to reward ratio inside the context area, then for me, entering on the fair value creation itself is perfectly fine. So for example, at this moment in time, right there, what do we see? We have this fair value being created that confirms that now an entry for me is actually valid. We have order flow confirmed actually going lower. So here, if I were to enter this, for example, right there, or to cover my stop loss right there, I would have an easy 1 to 2 inside the context. I would still have this whole area sitting right there, which I don't need to target. Again, do we always need to target the context low? Absolutely not. You do not need to target the context low or the context high at all times. Ideally, you want your 1 to 2 to be inside the context still, because again, the further away your target is, the lower the probability right there. That's extremely important to understand. Now, of course, we also need to understand we don't want to suffocate our stop loss. So we don't want to place our stop loss something like this where it still has a reason to return to, because then it is also a shame because you're not capitalizing on the high probability conditions on the higher time frame. Again, the reason why we get to an entry in the first place is because the high probability conditions on the higher time frame were there. They were valid to now look for an entry. The entry is most of the time the least of our concern because we already confirm the higher time frame PD rate that much. We're already very picky about that. So the entry is essentially just get involved as long as you have a good idea that it is going lower right there and you have somewhat of a confirmation. So that also means that don't suffocate your stop loss because that is truly a shame. Capitalize on that move. That's very important to understand. So if we can target 1 to 2 RR whilst I enter on the creation of the fair value gap. So again, the creation of the fair value gap, that fair value gap is confirmed is created once this third candle closes right there. So once the third candle closes, that for me would already be an entry. Now the tricky part right there is that if we experience drawdown, like this for example, we right there are going to have a more difficult time to actually go break even early on. This is where if you want to go break even earlier on, you might actually want to enter on the overlapping defense. For example, that verwijker right there is actually the overlapping defense. That will allow you to go break even earlier, because when you do experience some drawdown right there, it is likely not going to be a lot of drawdown in comparison to a lower entry like that. Now, you can also make this mechanical a little bit more, where if the 1 to 2 RR is easily targetable right there inside the context area still, you can enter on the verwijker creation. If that's not the case right there, then you would consider the flood. If the flood right there, the first line of defense, is still an easy 1 to 2 RR, but the verwijker creation is not, then enter on the first line of defense. If the flood is not an easy 1 to 2 RR, then enter on the overlapping defense. Now only enter on the overlapping defense if the retracement is not too crazy. And what I mean by that is, for example, right here. If we expect lower prices, we have a few choices. Where if we now want to enter, we can place our stop loss right there and then target this 1 to 2. But it isn't even a 1 to 2 because we can't reach a 1 to 2 anymore inside the context. So then we would have to target lower right there, which I personally do not necessarily like. So in a situation like this, I will consider, all right, well, we are not very likely to retrace to the overlapping defense sitting right there. I am not expecting a retracement towards that overlapping defense. Why not? Because that retracement will be a very far retracement, will be a very deep retracement before we actually decide to continue lower. That would be suspicious to me. High probability conditions happen fast. So in this scenario, I would rather enter on the first line of defense right there and cover my stop loss a little bit tighter than usual on exactly where I'm not expecting price to return to then target a 1 to 2 still in the context right there. That is what I personally would prefer. Again, those are all different options that you can also play around with, see what you prefer, see what you are better at potentially as well. So right here, I personally would not enter on the overlapping defense. But if we go a little bit lower right here, then before we take out that low, we see quite a big retracement. Now at this moment in time, we can decide to enter on the flood right there, and we can continue lower, and we can target a 1 to 2, or to make it a little bit more easy to target, if we do want to sweep that context low right there, then the overlapping defense will just squeeze out a little bit more RR right there. For if we do sweep that context, we do not actually continue lower, our 1 to 2 will still be hit. So that is where you can refine your RR a little bit depending on how far your 1 to 2 RR is as well. Where here, entering on the creation of the verwijker right there, the chance that we will target that 1 to 2 RR or will hit that 2 RR before we actually get a bigger retracement after reaching that context low, that's very high right there, that we are going to retrace quite deep before we actually continue lower. So the stop loss placement is not a good area anymore, as in we are not very likely to hit take profit. We are very unlikely as well to hit our break even, because going break even right there is also going to become quite difficult. So that becomes quite low probability. Where now, if we want to refine, we can look at the flood right there, first line of defense, or the odd right there to refine our RR. And the reason why this is so important to understand again is because we stop looking at entries when this context low has been hit. So any new entry that you would want to take needs to be inside this context area. If you are after that now looking for new entries, then what do you want to do? You want to wait for new context. So once we take out that low, you simply want to wait for, again, new 1 hour context or even 15-minute context to then continue lower off of that, but not following through on the 1 minute again. And that's extremely important to understand. Why is that important to understand? Because these 1 minute entries right here are just simply not good entries. That again leads back to the overall understanding of context, and that every time frame needs to be in context of the time frame above it. Now, with that word context, what I mean is if we leave behind fair value gaps, and for example, we were still in context right here. Let's say we were still in context. Then this 1 minute entry right there is not a good entry because we have a 15-minute fair value gap right there hovering right above us. So let's go over a few more examples. So here we are back on crude oil. And if we go over the 4 hour right there, we have this 4 hour value gap and we can follow through towards this context high right there. So now we have the context area again. On the 5 minutes, we can wait for a 5-minute sharp turn right here. We have a 5-minute sharp turn right there. And then we can continue higher. And here we are about to create the re. Not just yet. We have retraced into a discount rate. And this right here is the re. So either you can enter on the fair value creation itself. But let's say that you would like to enter right there on the float. And you were going to enter right there on that fair value gap. Would that be a good entry? Well, the longer the more time ticks essentially, and time is always ticking, the more fair value gaps we are going to create. And what I mean by that is we can't be stuck on the 5-minute time frame right here if that is our entry time frame. So even though, yes, we are looking at the 4 hour and the 5-minute combination right there, but we need to be aware of the time frames above us when we are still confirming an entry. Early entries like the ST plus the RE right there, those are perfectly fine because usually you don't have a fair value gap below you just yet that is on the time frame above you. But at this moment in time, what do we see? On the 15-minute time frame, we actually create this fair value gap sitting right there. So at this moment in time, would it be more wise to enter off of that 15-minute fair value gap or look for this 5-minute fair value gap right there to enter on? Well, the 15-minute fair value gap was not actually created just yet, but it is a lot easier to go up time frames right there to then simply look at a 15-minute fair value gap to then enter off of that instead of going into the 5-minute to then look at that entry. So every entry afterwards as well, what we need to be aware of is every fair value gap that we want to enter off of is there a fair value gap below this fair value gap, for example, on the time frame above us, hovering below that order flow lag, because then it's not going to be a good entry. So those time frames, again, they need to be in context of the other time frames as well. So going over US dollar, Canadian dollar, for example, right here, then here we see a sharp turn right there where we can continue lower off of right there. After that, if we want to continue lower off of that premium rate, this right here is the context area. Let's say this is the context area right there for example's sake. Then we have this sharp turn right there. Eventually we get a retracement into a premium array right there in the form of that fair value gap. Right here we get a new fair value going lower. We have the sharp turn plus the re right there. So this in itself is already a good entry, and every re afterwards can be followed through as well, can still be a new entry as well. So this in itself can be an entry right there, where this right now can also be an entry. But if you are looking to take multiple entries, again, make sure the first entry is definitely break even as well. Now, this right here is basic order flow entries. And I also want to go over a little bit of different entry types right here in this video, because the sharp turn itself can also be an entry. So here we have context time frame for ST entries. ST entries right here is essentially the same. The only thing that changes is the time frames. So if we're now looking at a monthly PD rate, we are looking at a daily sharp turn to enter off of. If we're looking at a weekly, then a 4-hour sharp turn, daily 1 hour, 4 hour, 15 minute, 1 hour, 5 minute, 15 minutes still is the 1 minute right there. The 15 minute really depends on what the overall context is as well. If you're only trading off a 15-minute context without any other context that is currently going on, so you're not moving from daily context to then you have inside the daily context also 15-minute context, then you can go into just a 1 minute sharp turn. But if it's only 15-minute context by itself, then I would advise go for a sharp turn plus a re as well. On EU, for example, we have this 4-hour value gap right there, which we can continue lower off of. And we have this context area right there at that moment in time. So instead of a 5-minute ST plus re, what you can also do is a 15-minute sharp turn. A 15-minute sharp turn is a little bit easier to actually see because you just need to have a clean sharp turn right there to then enter of the first fair value gap potentially right there depending on what the RR is, and then continue lower and target again that 1 to 2 right there. Now, this can be a little bit easier. A lot of people choose the sharp turn as well, but please understand that this entry you can enter before market structure shift. You can do a lot of fancy tricks with a sharp turn entry, but a sharp turn is also trickier. If you do not fully understand good sharp turn entries, you are going to get absolutely burned and you are going to blow accounts. That is just the simple truth of that. And again, that's the same for if you do not fully understand what is a good sharp turn plus a re right there. So please make sure that if you do want to use sharp turn entries, then study them, practice them, and see what are good sharp turns by the rules that we have gone over in this video as well. And for the ST entries, the same accounts as well, is that we have, if the closer the time frames are, the better the entry. So if we have a 4-hour Vega right there, 4-hour context area right there, then a 1-hour ST is even better than a 15-minute sharp turn. So if you ever see that, then you have, for example, you ever see a weekly fair value gap, which we can continue lower off of, you already have a daily ST, that in itself is already extremely high probability as well. The closer the time frames, the better the actual confirmation. The further the time frames are away from each other, the lower probability it is going to be as well. Then right here, what we need to go over next is some important details regarding risk management, of course. Here we see risk percentage right there. For the risk percentage, how much you want to actually risk. If you're looking to get funded, I am going to refer to the funded guide, which you also should have access to right there. For a live account right there, I'm also going to refer to the funded guide as well, because that's also where we go over a live account. Risk percentage is discussed right there inside the funded guide. So go ahead and take a look at that. That's where we go into more details. In different videos during this enrollment, we will also go over more details on that as well. Stop loss. Stop loss placement is going to be at the area where price turns low probability. So where price is not in your favor anymore, where price should not return most likely, that is where your stop loss is going to be. Break even right there is where price also turns low probability. So it's very similar to the stop loss rule. We can go break even when price has no reason to return. What it exactly looks like is also what we're going to go over. Take profit. 1 to 2 RR full take profit is something I like to do. Again, that's my personal preference. You can also experiment with it on your own, see what you like. Partials at 1 to 2 RR is something you can do, for example, where you take 80% off at 1 to 2 RR to then leave 20% running towards the next target, which can be the context area, for example, the context target. Now, personally, and from my personal experience, partials for me are simply not worth it. If I full take profit at 1 to 2 RR, usually I actually make more than if I were to partial and then hold the rest for the context area, for example. So partials for me are not worth it. I like to take full take profit at a certain target, which for me is always going to be a 1 to 2 RR, unless I am really convinced on a certain target, which is where experience also comes in. So let's go over the main thing right here, which is the stop loss target. Where the example on Euro USD is a good example right here, both for stop loss and as well for the target, because this target is actually right there below that context area. The 1 to 2 is below the context area. Now, if we want to look at a stop loss right here, then we are always simply said covering the previous order flow lag high. It's just based on the fact right there that we are not likely to actually sweep an order flow lag high, because an order flow lag high has a fair value gap in it. When we have a fair value gap in a lag lower, we are not very likely to sweep that high. So here, if you want to, you can even refine it to actually the body right there. And you can even use, again, the liquidity theory that we went over. If we are trapping people, refine it to that area right there. To that, if we are going to come above that high, it's going to be low probability, because we are making people comfortable and we might not actually be sweeping that high instead. So that is how you can refine that stop loss a little bit right there. Then for your target is a 1 to 2 RR, ideally within the context low right there. But sometimes that's not the case. If you still want to look to target below that low, then that is perfectly fine. make sure once we reach that low, that context low, and we have no context anymore, that you are at least break even, because we might just sweep the context low to then continue higher. Here, the highest probability target, the next highest probability target is going to be where we have no resistance. So let's say we have a fair value gap towards the left right there, which we might still target. That is also still high probability target, because below that low, if we have no resistance towards that next discount rate, that in itself is also a next high probability target right there. So that is where you can target even a little bit further. Or if your 1 to 2 is not in context, then that next target is also perfectly fine. That is not a big deal to me. Then when can you go break even? So for example, right here, this, whenever you experience more drawdown. So again, that is also going to be determined. If you struggle with risk management and struggle with break even rules, etc., then you might want to be a more accurate trader. Meaning you might want to wait for the overlapping defense to be traded into instead of always entering on the fair value gap creation itself. Because whenever you enter earlier, you are more likely to experience as well more drawdown. But again, it's picking your poison in that sense, because when you enter early, you're most likely always going to catch the winner as well. But if you enter more early, the risk management is going to be more difficult, most likely. If you enter late, you might not catch the winner, but sometimes you might actually get a really accurate entry right there where your risk management can be extremely accurate and you will not actually experience a certain loss, for example, because you can go break even extremely early, earlier than someone that enters earlier. So for example, right here, we, same as our stop loss, want to go break even based on order flow where price has no reason to return. Where here, price always has a reason to return before we actually hit our take profit right there. Now, if we're getting more specific, more picky, of course, then we can say once this candle right here, that last candle is actually continuing lower already, there's a new fair value gap in the making, we can already go break even earlier. Because at a certain moment in time, once we start running those lows right there, there is no real reason to retrace anymore, because that retracement now becomes extremely suspicious. So oftentimes people can go break even earlier than they think themselves. Now, a dedicated risk management video will as well be in this spring enrollment later on. Then if we move on towards the important part right here, there's a few important notes that I do want to go over right there. Re-entries. Every new order flow leg can be an entry, but take into account risk management and the context. Again, like we mentioned a little bit earlier, every new order flow leg higher can be a new entry, as long as you understand the context as well, as in there's no actual fair value gap below that context or below that order flow leg. For example, if we want to look to continue higher. So the fair value gaps are in context. You are break even as well. It's very important to understand that you can't just spam the button of buy at every new order flow leg. It does not work like that. Ideally, if you're just starting out, my advice would be focus on one singular entry in a context area. You don't need more than that in the beginning. Eventually, once you get more to the advanced stage, you can look at multiple entries in a context area. But first, just start off with one singular entry. Then next is context. Stop looking for new entries as soon as we take the context high/low. Whenever we take a context high/low, especially when you're just starting out with this type of trading, simply said, don't look for a new entry anytime soon. Go away from the chart, close your PC, close your laptop, shut off your phone, whatever it may be. Don't look for any new entries anytime soon. I would advise just simply wait for a new convincing context again. That's very important. Then right here, high probability conditions happen fast. You can be so extremely picky, and I think this is one of the main differentiators. I wait a lot between my next setup, and that is because I'm extremely picky about my setups. I know this is a marathon, not a sprint. I know my performance for investors is based on a yearly performance, not what I did last week, not what I did this month. Yes, monthly, potentially, more so quarterly, but it's mostly based on a yearly performance. So will my investor have a good return based on my yearly performance? Not, did you do 100% this month? Be picky, be extremely picky. We are always aiming to make 10,000 US dollars, wherever it may be, on a 1 million account. So we want a lot of capital and minimize our risk. Ideally, we want to risk 0.1%, and that still be a huge amount of money, where we don't want to look to take 10K to now a million. No, that's not the goal. And that is very important to understand as well, that we focus right here on a lot of capital with small risk. So allow yourself, be picky, be super picky. Don't think that every ST plus RE is a good ST plus RE. Because usually when I review the chart, and I review quite a lot of charts, I see, you missed quite a lot of details, where, again, I'm just trying to give you the right mindset, where just because we have an ST plus RE does not mean it's a good ST plus RE, does not mean that the higher time frame was good. So there, at every moment in time, at every single day, every single trading day, you can find ST plus RE. Does not mean it's a good ST plus RE. Please keep that in mind. The higher time frame is extremely important, and the higher time frame simply takes time to actually be good, to be high probability. So be picky about your price action. I can't emphasize that enough, because that's why the most losses happen, because you're not picky enough about the price action. Minimum right here. The ST plus RE combination is the minimum on the provided timeframes. So daily, 15-minute entry confirmation. Every confirmation more than that is better. So again, if you're looking at a 15-minute ST plus RE, plus RE, plus RE, that is higher probability, of course, than the ST plus RE. So the ST plus REs that I provided right there and the timeframes for the order flow entries, they are again the minimum, like we already discussed. So don't go below that, but you can definitely go above that. You can definitely require more. So if you're not sure if price wants to continue higher, wait for more confirmation. Buy an ST plus RE, plus RE, plus RE, plus RE, for example. Or wait for 1 hour ST plus RE instead of a 15-minute ST plus RE. Waiting for more confirmation, it's never a bad thing. Usually the bad thing happens when you do not wait enough for more, when you do not wait for more confirmation or for enough confirmation. That is usually the bad thing. Now, then I would advise right here, practice. And practice is mainly going to be waiting for the next video, because this is one entry type that we have. We also have candle science entries. So this right here might not resonate with you, might not make sense to you. You might not like it. It might start clicking with you, because this is also based a little bit on market structure, the intermediate term highs, intermediate term lows, like we discussed, because that's the same as the order flow. So in that regard, it might click with you, but it might not. And if it does not click with you, then do not practice anything and wait for the next video. But if it does click for you, then I would highly advise, go into your chart, look at context areas that already played out as well, or that sometimes fail. See what is the differentiator. Did we have a good, clean, sharp turn? How was the RE? What did it look like? Which time frames held? What kind of entry opportunities were there? If you want to study that, you can study that if this video resonated with you. Otherwise, again, I would advise to wait for the next video on candle size entries. All right, perfect. Thank you.